Can beginners use possible finance? That is the question so many of you are asking right now, especially those of you who are stepping into retirement, looking at your fixed incomes and realizing that sometimes life throws you a curveball. Maybe the car needs a new alternator. Maybe the water heater decides to burst on a Tuesday. And you look at your budget and you think, I just need a little bit of help to get to the next month, but I don't want to ruin everything I have worked a lifetime to build. So you see an app like Possible Finance online or on your phone, and it promises quick cash up to $500 with no credit check. It sounds simple. It sounds like an answer to a prayer for a beginner who has never borrowed money online before. But I want you to stop. I want you to take a deep, deep breath. Because when you are retired or when you are about to retire, you do not have the luxury of making mistakes with your money. You do not have years to recover from a bad financial decision. Your margin for error is zero. Let's look at the absolute truth of what this is. Possible Finance is a mobile app. It is a financial technology company that offers small dollar short-term installment loans and cash advances. Now, for a beginner, the app looks incredibly inviting. It tells you, we don't care about your FICO score. We aren't going to do a hard credit check that lowers your score. And for someone who is terrified that their credit isn't perfect, or someone who simply hasn't used credit in years because they paid off their mortgage and live a debt-free life, that sounds like safety. But how does it actually work? Instead of checking your credit score, they make you link your personal checking account directly to their app. They use an algorithm, a computer program, to look at your bank statements, your monthly income, and your spending habits. If they see a steady stream of money coming in, whether that is a paycheck, a pension, or your Social Security check, they might approve you for a small loan, usually starting around $100 or $200, up to a maximum of $500. Here's the fear that drives people to these apps. The fear is the alternative. You think to yourself, if I don't use this app, what choice do I have? I might have to walk into a predatory payday loan store. And let me tell you, payday loan stores are the absolute financial vultures of our society. They charge 400% interest, they demand the entire balance back on your very next check, and they trap you in a cycle of debt that destroys your peace of mind. So when you compare Possible Finance to a traditional payday loan, yes, Possible Finance looks better because they let you pay it back over 8 weeks in 4 installments, and they report your on-time payments to the credit bureaus to help build your credit. But just because something is better than a payday loan does not mean it is good for you. We need to talk about the cost, because this is where the truth comes out. While they say there are no hidden fees or late fees, these loans are not free. They charge a fee per every $100 you borrow, depending on the state you live in. When you calculate that fee as an annual percentage rate, what we call APR, the interest rate can still be anywhere from 50% to over 150%. Think about that. If you are on a fixed income, if you are living on your Social Security or a modest pension, paying an effective interest rate that high is a financial emergency in itself. You are taking next month's money to pay for today's problem, and you are paying a massive premium to do it. Can a beginner physically use the app? Yes, the technology is simple. It is designed to be user-friendly. You download it, you link your bank account, and the money can show up on your debit card in minutes. But the question you should be asking is not can you use it, but should you use it? If you are a beginner in retirement, your ultimate goal must be financial safety and security. Linking your primary bank account to a third-party lending app because you are short on cash means you are already vulnerable. What happens when the app takes the automatic repayment out of your account on the day your Social Security check hits, and suddenly you don't have enough left over for your prescriptions or your groceries? You get trapped in what I call the fintech quicksand. You borrow to cover this month, which makes you short next month, so you have to borrow again. So, what is your actionable takeaway today? If you find yourself facing an unexpected expense and you are thinking about using an app like Possible Finance, I want you to stand in your power and look at your other options first. First, look at your local community. Before you pay a massive fee to an app, call your utility companies or your medical providers directly. Almost every single one of them will offer a hardship program or a no-interest payment plan if you simply ask. They would rather work with you over 3 or 4 months than see you default. Second, If you absolutely must borrow a small amount of money, look into a small dollar loan from a local credit union. Credit unions are member-owned, nonprofit institutions. By federal law, federal credit unions cap their interest rates on payday alternative loans at 28%. 28% is a fraction of what you could end up paying on a short-term app. Third, use this moment as a wake-up call. If a $300 emergency forces you to look for an online loan, it means your current cash cushion is not strong enough. You need to create a small, dedicated emergency fund, even just $500 to start, held in a separate savings account that you do not touch unless it is an absolute matter of survival. You have worked too hard, for too many decades, to let a small dollar app dictate your financial freedom in your retirement years. Be strong, be smart, and protect your hard-earned money.